I've used this picture for years to illustrate investors seeking first the return and second the risk. In other words, I'm going to go out and look first at an investment and how much I can make on an investment. And then second, I'm going to look at how much might I lose if things go wrong, if ever. A lot of people never look at the risk. And then you see this guy here, he gets offered this job, I don't even know where he is, but let's say $7 an hour, he gets his job and he says, boy, that $7 an hour may not be worth the amount of risk I'm taking here to earn that money. And as investors, we do the same thing. We take these outrageous risks, and a lot of times the upside's not even that great, even if things go real well. And we look at that and say, well, wait a minute, why are we doing that? These coefficients that measure risk-adjusted return would tell us we've got this low alpha, which is how much return we're getting for the amount of risk we're getting. Return is always relative to how much we had to stick our neck out there and how much money we had to risk to do it. Now, there's a key to risk, and there's a key to mitigating risk. I'm going to teach that principle right now with a couple of live examples. As you think about real estate and the important words, there are 3 key words with real estate and correlated to its value. Location, location, location. And I'm going to talk about the key on risk management. It's consistency, consistency, consistency. We'll give you 2 examples. And this is a very common mistake, so I'm going to open your eyes up to a huge, huge myth, and we're going to talk about how we fix this. So you have 2 investors. Number one guy, he invests $100,000. He reads the magazines. He gets on the financial websites and looks at the news and the latest data, and he catches some good returns. He's up 30% in a year, but then he's down 10%. And every year, up 30, down 10, up 30, down 10. He does that for 20 years. Investor B is diversified. Very disciplined. Not only diversified, meaning they own a lot of investments, but the diversification is non-correlated and inversely correlated. So it's truly diversified. And we're going to explain what that means with an example. He's also disciplined. He invests when there's opportunities. He is greedy when other people are fearful, and he's fearful when everyone else is greedy. And he just makes 10% a year. Every year, 10% for 20 years. Now you look at that, and I always ask people, what investment performed better? Who did better, Investor A or Investor B? And everybody always says, well, boy, Investor B did better. Well, let's take a look. Investor A and Investor B both had an average annual return of 10%. Now again, I said people begin their investment experience by looking at what the return is. And they look at this and say, boy, 20-year average 10% return, that's great, I'm going to buy that. And that's what they're looking at, is the return. And it's all but meaningless, really, when you look at the average annual return, and I'm going to show you why. You see, we always have to do something called walking the numbers. It's not about what your average annual return is, it's how much money you put in your pocket. You see, now I ask investors, now that they know this, does it matter? In dollars and cents, did it matter whether you were Investor A or Investor B? And people invariably say, no, didn't really matter. Yeah, Investor B had a smoother ride, but dollars and cents, it was all the same. That is the huge misconception, and this is why you don't look at average annual return when you're picking an investment. Because Investor A made $480,000 with his 10% average annual return. And Investor B made $672,000. Now think of the difference. $100,000 makes $200,000 more. What a big disparity, what a big gap between Investor A and Investor B. Hence the importance of risk management. You see a lot of people nowadays trending towards investments and products that give them some guarantees. They don't have the upside, but they don't have the downside. And, one example of that, maybe not my favorite, but one example of that is equity indexed investments. A lot of people have equity indexed products, annuities, and life insurance, and if you can get past the strings attached and things like that, that's one of the ways people get some consistency. And over time, especially in these more volatile markets, which we expect based upon the volatility index increasing over the last decade, we would anticipate, boy, you know what? We're going to have more volatility. It's here to stay, and so we need to look at ways to get more consistency. Well, my favorite way to get consistency and the least expensive way without paying an insurance company a bunch of money is to simply diversify. Now let me explain what I mean by non-correlation and inverse correlation of assets. Your friend comes to you and he wants to sell sunscreen, but he also has room in his store to sell maybe another product. And so he says, should I sell sunglasses or should I sell umbrellas? And you look at him and you say, well, if you sell sunglasses, if it's always sunny there, that's great, but you know what? It rains here 4 months out of the year and you won't sell anything. And as a small business owner, you can't have a couple of months where you just don't make anything. So you say, boy, you really ought to sell umbrellas and sunscreen, or umbrellas and sunglasses. But don't do 1 and 2 and skip 3, because then your business will get crushed in the rainy months. And we have rainy months in all economies and all markets. So we look at that and we say, okay, let's chart this out for a minute here. Suntan lotion sales do great when it's sunny. When it's rainy, they do terrible, clearly. Umbrella sales, the opposite. So if you consider that he had both, and we have half suntan lotion and half umbrella sales, we have performance that looks more like this. Now understand, this is not scientific. This is not, it is a mathematical equation, and so it's reliable data, but it's not a CD. We're not buying a fixed annuity or a CD. We're not buying a government bond here. So we are going to have some fluctuation, but you can see that final line, that 50-50, gets a lot more consistent the other two lines. So the key to risk management is having the right correlation of asset classes in a portfolio. When you do that, you end up with, as investor B, with more money in your pocket at the end of the day.